The Fed is about to cut rates. Stock investors, do this right now. When the Fed cuts rates, it's often a signal that the economy is weakening and possibly heading into a recession. But here's the twist. Those same lower rates can be great for certain companies and stock valuations. In this video, I'm going to show you how to take advantage of the Fed's upcoming interest rate cuts. You'll learn exactly what kinds of stocks to buy and which ones to avoid. By making a few smart moves right now, you could be setting yourself up for some impressive gains. I'll walk you through why growth stocks, small banks, REITs, and even dividend stocks thrive when rates are low. And I'll also share some specific stocks and ETFs to consider. So if you're ready to make the most of this rate cut and boost your portfolio, let's dive right in. Why the Fed's interest rate cut matters for investors. So why should you care about the Fed cutting interest rates? Here's the deal. When the Fed lowers rates, it becomes cheaper for companies to borrow money. This means businesses with a lot of debt or those looking to expand can save a lot on borrowing costs. As a result, they end up with more cash, which can lead to higher profits. Now, you might be thinking, wait, isn't a rate cut a sign of a weak economy? You're right, it often is. When the Fed cuts rates, it's usually because they're trying to stimulate the economy, which could be showing signs of a slowdown. But here's the twist. Even though the economy might be weakening, certain companies benefit from lower borrowing costs, which boosts their cash flow and improves their profitability. For example, growth companies, small banks, real estate firms, and some tech companies tend to thrive when borrowing costs drop. This is because they often rely on external financing to expand their businesses or invest in new projects. Lower rates allow them to borrow cheaply and increase their cash flows. As an investor, this is where you come in. By focusing on the right sectors and the right types of companies, you can ride the wave of this rate cut and watch your investments grow. Next, let's take a look at which specific stocks to consider, starting with the big players in the tech world. Buy growth stocks like the Magnificent 7, but avoid Tesla. When interest rates drop, growth stocks are some of the biggest winners. Why? Because growth companies tend to borrow a lot of money to fuel their innovation and expansion. Lower borrowing costs mean they can keep more of their profits, which often results in their stock prices rising. Now let's talk about the Magnificent 7. Google, Facebook, Microsoft, Apple, Nvidia, and a few others. These are the giants of the tech world, and they're well positioned to benefit from the upcoming rate cuts. They have strong balance sheets and rely on borrowing to fund new projects and technological developments. Lower rates mean these companies get to keep more cash and reinvest in growth, driving their stock prices up. But here's the catch. Not all tech stocks are created equal. One big name you might want to avoid during this time is Tesla. Yes, Tesla is a tech giant, but its stock is highly volatile. With competition in the electric vehicle market heating up and some operational challenges, it might not be the safest bet during this period. Tesla's high debt load and reliance on external financing make it more sensitive to risks. Instead, focus on companies like Microsoft and Apple that are more stable and can benefit more predictably from lower interest rates. Tech stocks aren't the only ones that benefit from rate cuts. Let's explore the real estate sector next, an often overlooked winner in low-rate environments. Invest in the real estate sector and REITs. When interest rates drop, one sector that stands to benefit big time is real estate. Why? Because real estate companies and investors rely heavily on borrowing to finance property purchases and development projects. Lower borrowing costs mean these companies have more money to spend on new projects, which boosts their cash flow and profits. Real estate investment trusts, or REITs, are a fantastic way to invest in real estate without having to buy and manage properties yourself. REITs pool money from many investors to buy income-producing properties like shopping malls, office buildings, or apartment complexes. They are required by law to pay out most of their profits as dividends, so they can be a great source of passive income. A couple of great REITs to consider are Realty Income O and Federal Realty Trust, EFRT. Both are well-established and offer solid returns. If you'd rather spread your risk, you can invest in REIT ETFs like SCHH or VNQ, which give you exposure to a variety of real estate investments. With interest rates dropping, the real estate sector is expected to perform well, and investing in REITs can give you exposure to this growth while also providing you with regular income. But real estate isn't the only sector that will see gains. Let's talk about small cap stocks. These can be a hidden gem when rates drop. Focus on small cap stocks for big gains. Small cap stocks are companies with smaller market values, and they tend to be more sensitive to changes in interest rates compared to large cap companies. Here's why. Smaller companies often rely more on external financing to grow, meaning they take out loans to fund their expansion. When interest rates are high, borrowing is expensive, which can limit their growth. But when rates drop, borrowing becomes cheaper, allowing these companies to reinvest and grow faster. As a result, small cap stocks can see big gains when the Fed cuts interest rates. These companies are more likely to use the savings from lower borrowing costs to fuel growth, leading to higher stock prices. And since small cap stocks are more volatile, they can outperform their larger counterparts in a low-rate environment. If you want to add small cap stocks to your portfolio, look for companies with solid fundamentals and growth potential. Or you can invest in small cap ETFs to spread your risk across multiple companies in this space. With all the growth opportunities, it's important to also balance risk. That's where defensive stocks come in. They provide stability even during uncertain times. Defensive stocks are your safe bet. When the economy shows signs of slowing down, defensive stocks are a safe bet. These are companies in sectors that provide essential goods and services, things people need no matter what's going on with the economy. Think utilities, healthcare, and consumer staples. People will always need electricity, healthcare, and food, even during a recession. Utilities in particular tend to perform well during periods of economic uncertainty. Utility stocks are considered defensive because people continue to use electricity, water, and gas no matter the economic environment. A great way to invest in this sector is through the Utility Select Sector SPDR ETF, or XLU, which gives you exposure to a range of utility companies. Consumer staples like food and household products are another area to focus on. Companies like Procter & Gamble or Coca-Cola provide goods that people buy even when budgets are tight. You can invest in this sector through ETFs like the Consumer Staples Select Sector ETF and XLP. By adding defensive stocks or ETFs to your portfolio, you'll protect yourself from downside risk while still benefiting from the Fed's rate cuts. Lastly, let's talk about a way to generate reliable income during times of uncertainty. Dividend stocks. Buy dividend aristocrats and dividend ETFs. Dividend stocks are a great way to generate steady income, especially during times of uncertainty. Dividend aristocrats in particular are companies that have consistently increased their dividends for 25 years or more. These companies are reliable, and their regular payouts can provide you with a steady income stream, even when stock prices are volatile. When interest rates are low, dividend stocks become even more attractive because investors look for other ways to earn income. Dividend aristocrats like Johnson & Johnson, Procter & Gamble, and Coca-Cola are solid picks. These companies have a long history of paying reliable dividends and are likely to continue doing so. If you'd rather not pick individual stocks, dividend ETFs can be a great option. ETFs like the Vanguard Dividend Appreciation ETF, VIG, or the iShares Select Dividend ETF, DVY, provide exposure to a broad range of dividend-paying companies. This gives you diversification while still earning regular income from dividends. By investing in dividend stocks or ETFs, you can create a reliable income stream while also benefiting from potential price appreciation as rates drop. Payoff. You've now got the tools to adjust your portfolio ahead of the Fed's interest rate cut. From growth stocks like the Magnificent 7 to REITs, small caps, defensive stocks, and dividend aristocrats, these investments are positioned to perform well as rates drop. The key takeaway? While rate cuts are often a sign of a weakening economy, they present a great opportunity for investors who know where to look. By making strategic investments now, you can benefit from lower borrowing costs and set yourself up for future gains. So don't wait. Review your portfolio, make adjustments, and position yourself for success as the Fed makes its next move. Timing is everything. Get ahead of the curve and watch your investments grow. Thanks for watching. If you found this video helpful, don't forget to give it a thumbs up and hit the subscribe button for more investment tips. Let me know in the comments if there are other topics you would like me to cover. Catch you in the next one. Your financial future is waiting.